Welcome to Intermediate Accounting, Chapter 8. In this chapter, we're going to be talking about inventory measurements. There are going to be multiple chapters on inventory because there is so much to account for when it comes to this asset. So let's jump right in. So when it comes to inventory, surely you already know what it is, but just to make sure, it is an asset that refers to the goods a company owns and intends to sell as a part of their regular business operations. So we know inventory does not include the delivery trucks or the warehouses or the equipment. All of that would be separate assets unless that is what we sell as a business. But overall, it's the things that we are purchasing, or maybe it's parts that we're purchasing in order to then later sell it to customers for normal business operations. Cost of goods sold is the cost of inventory. It is an expense that we know goes typically right under revenue, where we are going to see how much did it cost for us to purchase or create this product that we sold. So this is when inventory leaves the balance sheet and moves on to the income statement. That is cost of goods sold. So there are two different types of inventory. There is merchandise inventory. So this is used by retailers and wholesalers. That is going to be like Walmart and Target. So they are purchasing things from different outside companies, and then they are selling it to the customer. So they're the middleman. Walmart, the stores that you go into, they are not assembling the items that you're purchasing. They do have some of their own items, of course, but for the most part, they're a retailer where they're bringing in all these different brands of makeup and soap and chocolate and all these different things, and then they sell them to you. So that is the retailer, that's the merchandiser. They're not the ones putting the product together. So the only category they have is finished goods that are ready to sell. Now, they're like for Walmart, their Equate brand or their Good Value, is it Good Value brand? No, I can't. Or Great Value brand. It's not good, it's great. Those brands that they are making as a generic brand for Walmart, that would be accounted for separately than the stores that are going to be selling the goods directly to the retailers. So they all have just finished goods ready to sell. They purchase them in bulk and then they sell them to you individually. So they buy those companies, they sell them without changing them. They buy Dove chocolate, they buy Dove soap. The other day, my husband said, "What do we need from Walmart?" And I said, "We need Dove soap and Dove chocolate." And he did go get Dove chocolate. He's like, "I had to make a special trip for the Dove chocolate." I'm like, "A special trip? You had to go to a different store?" He's like, "No, I had to go to the other side of the store." So I guess at Walmart, it feels like a separate trip. Anyway, I guess we know what I'm going to be doing after this video, eating chocolate. So then there's manufacturing inventory. This is used by companies that are actually creating the products, like Ford creating their vehicles, or General Motors. General Mills. They have so many different products that they create, like cereal. So these have three categories, and you should recognize these if you have taken managerial accounting or cost accounting. There's going to be raw materials. This is where it's just parts or it's just ingredients. So they've purchased, sugar and flour and oil if they're making cakes. That's the raw goods. Then there's work in process. Work in process is where we are taking those ingredients and we are in the process of turning them into what we will ultimately sell. So we have the flour and the sugar and the oil and we're mixing it together, but a month in, hands off, right now, those cakes are not done. That may not be the best example because I would hope that a cake we would actually finish before the end of the day. But you know what I'm saying, right? So whenever we finish the month, there may be bicycles that there are parts that are together and there are some that are not. So those bicycles that are not fully put together, those are going to be a work in process. So then we have finished goods. Finished goods are when we have the bicycle fully put together. We are ready to sell it to the customer. We have the cakes baked and iced, and we are ready to sell that and put it in the display case. Those are our finished goods. All three of these categories do count as the asset of inventory, but they are just in different stages for a manufacturing company. So they make the products that they are going to sell. So again, if it goes to Walmart where they have some of their own brand, the retail side of it would be merchandise inventory, but then the side that makes equate and great value, those would be a manufacturing side. So those would be accounted for in both of these categories separately. So we've already talked about these three stages of manufacturing, but just to kind of refresh, we've got raw goods, the basic components, those ingredients that we have or those parts that we have that will ultimately create the finished product. Still going to be inventory, but not going to be ready to sell yet. Work in process or work in progress, you're going to see it both ways. So I put it different on each slide here. But the work in progress, it is going to be as it is in the process of being manufactured. So at the end of the accounting period, where do we cut that off? Okay, if these are not ready to sell yet, then we're going to say those are in the work in progress inventory. Then if they are finished and they are ready to sell, they are packaged and everything, it would be finished goods inventory. All of these together make up one big inventory number, but we like to keep them separate, especially for management, so that we can see where we are in the process of inventory. So now we're going to walk through the manufacturing process, because you've already seen this in managerial or cost accounting most likely, because this is the foundation of that. So we're not going to dig into it too much in this class, but I just want to touch on this process to make sure you fully understand what is happening with manufacturing inventory. So we start out with our raw materials, whether that's our ingredients to make our cake or our parts to make our bicycle or car or whatever it may be. We take those raw materials, which are inventory, they just haven't been turned into the finished product yet. And as we use those up, they are going to be moving somewhere else, and we're going to see that in just a minute. But let's talk about what else is going to go into that. We have direct labor. Direct labor, that is going to be the people who are actually hands-on creating the product. So if it is a bicycle, it's the people who are assembling it. If it's a cake, it's the people who are, mixing the ingredients, who are icing it. Hands-on labor, that's what's going to fall under this. So we're going to see it actually turns into inventory. So if you work on an assembly line or you work with parts that are going to create a finished product to sell, your labor is actually turning into inventory, not an immediate expense. So that's different than we've seen with any other labor. Then we have the trickiest one, which is manufacturing overhead. This is all of the indirect costs that we have, whether that be the labor of the supervisors to make sure that you're baking the cake at the right temperature, or you are putting the pedals on at the right place. This is going to be maybe their salary. This could be depreciation and maintenance on the equipment that you use to put the finished product together. This could be the depreciation on the building and the electricity and the water and the heat and air that is used for your building that the manufacturing is done in. Not for the offices or anything like that, but just anything that is solely focused on manufacturing this company's goods. That would be manufacturing overhead. And the reason that those two say applied is because a lot of times, especially with manufacturing overhead, those are going to be estimates. We may not know exactly how much labor or how much of all of these indirect costs it's going to be to make the product, because, at the end of the year, we might say, oh, the maintenance was a lot more than we expected. But we are going to have to make an estimate as we go through the year so that we can ultimately get to how much did these goods cost. So we take the raw materials that we are now putting into the work in process, and we take the direct labor that is a part of the work in process, and we take all those indirect costs and we move all of those to a debit in work in process inventory. Remember, raw materials is inventory, so it has a normal debit balance. So when we use those up, we just move those to the next inventory account, work in process. So we debit work in process as we use those. For the direct labor, we debit work in process to increase that inventory. And for all of those indirect costs, we debit work in process to increase the inventory that is in process. And of course, as the actual costs come in, if they purchase more raw materials, we'll increase raw materials with that debit. And whenever we actually incur the direct labor cost, we are going to have direct labor costs incurred, which we're going to be showing there as a debit. Manufacturing costs, as we incur those, we're going to be debiting those as well. And then you see in cost accounting how you have to look at if there were overages and shorts, but you don't have to do that in this class. So we'll just say that. Then, as you're processing those, the ones that are finished in the accounting period, we want to move out of work in process with a credit, and that's where we take them to finished goods. So then we have the finished goods, we have them on display, we have them listed on the internet, whatever it may be. And when we actually sell those, we move it to the income statement to cost of goods sold. So this is the process for manufacturing. It's a lot to keep up with, and it's primarily important for managers to be able to see where the inventory is in the process. But this is financial accounting, it's not managerial accounting, so we don't get any further into that in here. So now we're going to look at the two different types of inventory systems. The first one being perpetual. Perpetual inventory system continuously tracks inventory levels in real time. How do they do that? Typically with barcodes, right? Typically, they're going to be able, if you go to Walmart, even if you're checking yourself out now, you will be using barcodes, and it immediately updates their inventory. So it ensures accurate and timely data with automatic updates at each transaction for better decision making. So they know as soon as you buy that Dove chocolate that they have one less bag of dark Dove chocolate. Does anybody want to send me some of that? That would be fantastic. Or the mint Dove chocolate. That stuff's so good. But I think they only sell it at Christmas time. I don't know. Anyway, now I'm going to definitely have to go get some chocolate after this. Okay. So whenever you scan that barcode, it then immediately updates Walmart's system to say, we have one less bag. And as they get to a certain level, whatever level they've set, they immediately know they need to order more Dove chocolate in case I come back to get more. So it is always keeping up with it. And primarily that's done with barcodes. Not everyone uses that. So I'm excited because we have a new case study for this chapter that we're going to be working through the examples with. It is Galactic Gadgets, a sci-fi gift shop selling quirky space-themed gadgets. So this is the little shop. There's a huge market for this, right? Maybe in like Roswell, New Mexico, but all right, so let's look at Galactic Gadgets, and we're going to get in our first example. So scanning the galaxy for an example, and it was located. That's really cheesy. I know, I'm sorry. It's fun though when you're working with all this accounting to get to add some creativity. So Galactic Gadgets purchases tech accessories from manufacturers and sells them to intergalactic retailers. The company uses perpetual inventory system to track inventory costs and quantities, so they're always keeping up with it. At the start of 2025, Galactic Gadgets had $95,000 in inventory. During 2025, the following transactions occur. So they've already got 95,000, and I'll just tell you, if you like to use T accounts, keep up with this in a T account. Those can be super, super helpful. So I would make a T account that says inventory, and then you'll be putting a debit for the goods they already had in inventory, which was 95,000. Then they have additional tech inventory that's purchased on account for 480,000. So we again will be debiting inventory. We're going to walk through the entries for this, but if you want to keep track of it in a T account, you put a debit for 480,000. Then we have sales for the year on account, total 700,000. Okay, so that's the sales number. That doesn't mean that's how much the inventory costs. That's the revenue that we see. So we would have a whole separate account for that, putting that into sales revenue. But what is the cost of it? The cost of the inventory sold was 410,000. That means we got rid of that inventory, we moved it to cost of goods sold, so we would be crediting inventory for 410,000. According to the perpetual inventory system, the ending inventory at December 31st, 2025 is 165,000. So if you took the debit for 95,000 plus the 480,000 of purchases, then you subtract out the 410, you should get 165,000. So let's look at the journal entries for those. So I'll go back for 1 second in case you want to take a picture of this so that as we go through the journal entries, you'll be able to identify exactly what we're doing. All right, ready? Let's go. So the first journal entry, and this would really be happening all throughout 2025, debiting inventory for 480 and crediting accounts payable, assuming they don't pay immediately. So this is what happened all throughout. So there were probably, dozens of entries that totaled this, but throughout 2025, they made purchases of 480,000, and then later they'll be paying for that 480,000. So that's how we increased inventory. Then we also, throughout the year, had recorded sales of 700,000. So we would have debited accounts receivable or cash if the customers paid in cash, and we credit sales revenue. And then for the inventory aspect of it, it would be cost of goods sold. We always, when we sell a product, we have to have the cost of goods sold and inventory entry to match up with the sales entry. So we debit cost of goods sold for 410,000 because that's what it said it cost us. And then we decrease our inventory for 410. So we keep track of all of that from our 95,000 that we already had in inventory. We added 480, we subtracted 410, we should end up with 165,000. So let's move on to the periodic inventory system. So this updates inventory and cost of goods sold only at the end of the accounting period, not after each transaction. So perpetual keeps up with it all the time, which is so helpful, but it can also be very cumbersome and very expensive. So sometimes we see smaller businesses that will use periodic. So how this works, they record purchases in a purchases account. So that's different. They're not putting it in inventory as they make the purchases. So we're going to walk through all this together. There are no updates to inventory or cost of goods sold throughout the accounting period. They do it at the end, typically at the end of the year. So then at the end of the period, they are going to take this formula and they have to do a physical count in order to get to this. They're going to take this formula and it is going to tell them how much their cost of goods sold were. So we have our beginning inventory. Okay, so we already knew that, plus all the things we put in purchases throughout the year, minus the ending inventory. Ending inventory is only determined by a physical count. So the pros, it's simple and affordable, and it's good for those small, low volume businesses. So if it's just a mom and pop ice cream place, they're probably not going to be keeping track of it constantly. Mark down that we sold another strawberry ice cream, one last scoop. No, they probably at the end of the week look around at the ice cream. Okay, so we're low on strawberry. We're low on peach. We have tons of vanilla because it's so boring, right? So vanilla. And they're going to keep track of it in that way. The cons, there's no real-time tracking. So while it can be expensive, you're not keeping track of it all the time. It can't detect losses and theft as easily. If you're not counting until the end of the month or the end of the quarter or the end of the year, you might not pick up on the fact that you have an employee that is committing theft on a regular basis, not in time. And the cost of goods sold is only known after the physical count. So you don't know what cost of goods sold is throughout the accounting period. You just know it at the end. So those are some cons. Space tip. This method checks your inventory after the mission ends. No mid-flight course corrections. I'm sorry, y'all. That was stupid. That was really, really cheesy. All right, let's look at Galactic Gadgets and their periodic inventory system. So we've got the same situation, but they keep track of it with periodic inventory. So they have beginning inventory of their 95,000. They made purchases of 480,000 throughout the year. And then their sales, again, were 700. Their ending inventory, they only know from a physical count, is 165,000. So they have to use this formula after doing the physical count. They say last year our physical count ended with 95,000. We added 480,000 we see in our purchases account. Then we did a physical count. We said we still have 165,000. So when we subtract that out, that would leave us with 410. So 410 is how they get their cost of goods sold. So the cost of goods sold is only after that physical count at the year end. The inventory is not updated during the year, and they have purchases in a separate account from inventory when they use this periodic inventory system. And this is really the only time we're going to talk about periodic inventory. After this, we always use perpetual in these classes. So let's look at our journal entries for this periodic situation. So in 2025, instead of debiting inventory, they debit that purchases account that is only used in periodic method. So we have 480,000 and then again accounts payable. Then same for our sales as we have with perpetual, they show accounts receivable increasing and sales revenue. But then it gets tricky at the end of the year because they did not keep up with cost of goods sold all throughout the year. Instead, at the end of the year, and it's possible for a company to do it throughout the year, maybe they do it on a quarterly basis or something. But in this case, at the end of the year, they did that physical count. So they did that whole calculation to find that it was 410,000 in cost of goods sold. If you didn't go in and do that calculation, you could just do the journal entry, fill out the bottom three, and then it would work into cost of goods sold in the journal entry as well. So a little odd because we're debiting and crediting inventory, but it just helps us to see a clear picture. So a lot of times with accounting, it might look like, oh, we're doing something tedious here. But if someone were to go back 2 years from now and look at this entry, they'd be like, oh, okay, there's notes. First of all, you see each of these journal entries have notes, and it will in the real world as well. But we'll look back and say, okay, so instead of just netting out inventory, we were able to look at it and say, this is what the ending was. The physical count told us that we had 165,000 in ending inventory. So we debited inventory for that. Then they did a credit for inventory for 95,000. Sure, it nets out, but this way we're able to really see the movements here. And then we get rid of the purchases account completely, that whole 480, and then that tells us cost of goods sold were 410. So this is how periodic will look. Again, we won't deal with periodic again after this, but I just want you to be aware of it if you happen to work for a company that uses this and for your homework. So last couple of slides here just to remind you what's happening for the cost of goods sold. They began with inventory of 95,000, and I'm going to pop this up here too. Then they had during the year, and so the colors correspond. Beginning inventory is blue, and then the numbers blue, 95,000. Then they had additional purchases of 480. Then they subtracted out the 165 to get to our cost of goods sold of 410. So maybe this is a real clear way for you to be able to see it broken out. So again, the colors coordinate with each of these numbers. And then last slide, just a reminder, we're taking those same numbers and that same journal entry we did last, just to make sure it's all making sense where they're coming from. So we had the beginning inventory. We want to get that off the books. A little weird the way we do it, but just to keep that really clear trail of what's happening. We get the 95,000 off the books by crediting inventory for the beginning balance. We are going to credit our purchases because we've got that. That's a temporary account. Yes, it is a balance sheet account, but that one is temporary. So we get that off the books because it's going to be reflected in inventory now. Then we are going to debit inventory for what we actually have on hand, the 165, which tells us our cost of goods sold is 410,000. All right, I'm going to end the video there because we have lots more, and it does get more challenging as we talk more and more about inventory. So be sure to stay tuned for the next bit of information here.